Good morning and welcome to Charting the Markets on Wednesday, the 3rd of May. Let's begin by having a look at today's economic calendar. And at 1:15 p.m., we've got US ADP employment data out for the month of April, where we expect 150,000 jobs to have been created, just as was the case in the month of March. And we also at 3 p.m. have the US ISM Services PMI data out for April, which we expect to fall to 50.6. And that is then followed at 3:30 p.m. by the US EIA crude oil inventories for the week ending the 28th of April. And we anticipate stockpiles to have fallen by 5 million barrels in the preceding week. And then all important at 7 p.m., we've got the Federal Open Market Committee meeting. So basically FOMC rate decision. And we expect the Fed to hike its rates by 25 basis points to bring the Fed funds rates to between 5 and 5.25%. The commentary around the potential future hikes or a pause will be key for market direction. And perhaps we'll also have a mention of the US looming debt ceiling crisis, but the Fed is unlikely to decide anything to do with its monetary policy with this in mind. But let's begin by having a look at the FTSE 100 and the impact yesterday's sell-off in the US markets has had on this index here. And as you can see here, we had a very sharp decline yesterday by over 1%, in relatively speaking, relatively sharp, because if you compare the volatility we've seen yesterday and the speed of the descent to the previous weeks of smaller candles, you can see that the momentum has shifted to the downside here. And this was on the back of the US regional bank index, basically dropping by about 6% yesterday. And that was despite First Republic Bank being rescued by JP Morgan earlier this week. But as fears of contagion hit US markets. And you can see here the FTSE 100 today is trading in very little volatility. Now, that's not surprising because we are all awaiting this evening's Fed decision. And basically, if we were to slide through yesterday's low at 7,763, basically, if that were to happen, we could then drop towards the late January lows at 7,724 to 7,708. So this would be the next target area where the FTSE 100 may hold. If not, we've also got the 38.2 Fibonacci retracement of the entire March to April advance, which can be seen at 7,652, I believe. So that would be another potential downside target for the FTSE 100. But from a technical perspective, it does look and seem more probable that we will see further downside in the short term unless we were to manage to rise and reverse above yesterday's high at 7,897. If we were to close above there, the recent upside should continue. But as long as we stay below there, the odds favor further short-term downside to be seen with regards to the FTSE 100. And the same story is really true for the DAX 40 contract. Here you can see the German index is actually showing negative divergence. Yesterday, it rallied to a level last seen in January of 2022 to slightly above the psychological 16,000 mark before then being dragged down by the weaker US equity indices. And basically, that latest price high we made on this daily financial bet at 16,009 has not been confirmed by a higher reading of the relative strength index here. And you can see here the latest high we've seen on this index, on the oscillator, the RSI is actually pointing lower, although the price is making a higher close here and pointing up. So this is basically showing you negative divergence. And when that happens, then most of the time we do have at least a short-term stop in the previous trend, short-term consolidation following the previous trend, and sometimes it leads to a major reversal in the previous trend. You can see here, for example, in March, and we did allude to that back in the day, we had lower lows on the daily price chart, but we had higher lows on the relative strength index. So here we had positive divergence, which then led us to rally all the way up to 16,000 or so just this week. So what am I saying? Well, basically, if we were to fall through the low seen last week at 15,694 on the daily financial bet for the DAX 40 contract, then I expect a top to have been formed, meaning that we could very easily slide back to not just the early April low at 15,480, but probably also all the way back to the Wednesday 22nd of March high at 15,304. So we could see quite a considerable correction lower taking shape if we were to fall through 15,694 on a daily chart closing basis. Now, as long as that low holds, further upside may still be seen. So this is really the line in the sand from a technical perspective for the DAX 40. Moving on to US markets, you can see here the S&P 500 is showing a similar negative divergence with the relative strength index, in that we are forming a lower high here, yet we made a higher high at 4,187 on the daily financial bet just on Monday of this week, very close to the February high at 4,195. And this is really key because that resistance area is capping at the moment. And as long as it does, we may slide back not just to the March to May uptrend line, which currently see in 4,088 today, but also to last week's low at 4,050. If that low, the last reaction low here, were to be taken out, then for me, it would mean that the odds have shifted to the downside, that we formed some sort of topping pattern here, and that we should slide all the way back down again towards the 200-day simple moving average here at 3,971. So in case of the S&P 500, the level to watch out for is 4,050, provided we stay above there, and ideally also above the March to May uptrend line, we may still head higher. And if we were to manage to rise above not just this week's high, but also the high seen back in February at 4,195, then we could, if we zoom out onto a weekly chart, rise all the way back up again towards the August high of last year at 4,325. Because in that case, as you can see here, we've got a plethora of previous highs, which would then be taken out. And that would mean that we formed a medium-term and actually a long-term bottoming formation here, and that the long-term bull market could then resume. And you can see here the bull market actually, when we had the bear market from last year, took us back down to the 200-week simple moving average. And from there, we have then stayed above there for the last 2 quarters, which in itself is also quite positive. So let's just see what happens in the short term with regards to the rate hikes and also the forward guidance later out today from the Fed. The currencies such as the US dollars obviously also are influenced by the rate decisions out later today from the Fed, where we expect a 25 basis point rate hike to take the Fed funds rate to between 5 and 5.25%. But tomorrow we'll also have the ECB out, and there we also expect for the European Central Bank to hike its rates by 25 basis points at the very least. So let's look at euro dollar. And as you can see here on the daily financial bet, we have once again bounced off previous support here. We've got the March to May support line, and we are currently heading back up again, are trading back above the psychological 110 area, and also at the moment flirting with the February high at 110.33. Now, if we were to continue our ascent later on today, after the Fed has made its rate hike announcement and talked about its forward guidance, meaning is it going to talk about potential further rate hikes being necessary in order to reduce inflation in the US, or is it now likely to pause for the next few months in its monetary tightening cycle? That is the real question, and that will also determine where equity markets are going to head. If we were to see a weaker dollar, meaning euro dollar were to head higher again, we could then head back to the mid-April high at 110.75 and also the late April high 110.95. And a rise above there could take us to highs seen back in 2021, if I remember correctly. Actually, no, 2022. The March high was made at 111.85 there, and you also have the 200-week moving average there coming in at 111.96. So these are the potential upside targets. in case of further upside being seen for euro dollar. And this will remain the case from a technical perspective as long as we stay, sorry about these lines, above yesterday's low, Tuesday's low, that is to say at 109.43 on a daily chart closing basis. So here, that is the line in the sand for euro dollar. Now, moving on to the Australian dollar versus the New Zealand dollar. Now, I don't normally talk about this currency pair, but yesterday's trade of the week was to go long on this currency pair because basically what happened overnight, we had a surprise rate hike by 25 basis points, taking the Australian central bank's rates to 3.85%. And the central bank also said that it might have to tighten its monetary policy even further in order to bring down its stubbornly high inflation. And you may remember I mentioned yesterday that the inflation rate in Australia at the moment is at 7% year on year. So we did have an inside basically bar or here a harami pattern on the daily candlestick chart, and we broke out of it. And that's why I thought we could have a reversal to the upside, and also given the fundamental background. But that has now turned into a failure pattern here, and downside momentum taking us back to the late February lows at 106.83, which leads me to believe that perhaps on this trade, a stop and reverse order might actually be the right thing to do, because basically the upside momentum has turned completely negative very, very quickly. And that normally is followed by further downside being seen, which could then take us back down again towards the uptrend line going back to December of last year. And that currently can be seen at 106.18, below which we also have the April low at 105.88. Failure there could then take us all the way back down again to a December low at 104.72. So given the pattern, it looks now to me as if I was wrong on my trade from yesterday, that's for sure, but also that the momentum has clearly still been, or is still pointing lower, as it had been since the sort of 2 weeks ago nearly, since the high seen back just below this 200-day simple moving average here at red at 109.35 on the 21st of April. So probably further downside being in store with regards to the Australian dollar versus the New Zealand dollar. And if you were to go short on that trade from a technical perspective, what you need to do is put a stop loss above the 108.34 high seen yesterday. Moving on to the Japanese yen. Now, this is another trade from 3 or 4 weeks ago we had on. We were long from 133.35 on dollar yen. And this one we got out of yesterday because we saw that we were testing not only the March high, but that we also did so around the red line here, the 200-day simply moving average 136.96, both of which meant that the odds were pretty high that we were likely to fail in this area, and also below the December high at 138.17, which is why we exited that trade with about a 400 tick profit. And as you can see here, this resistance area I just alluded to has acted as resistance, and we're currently coming off again with regards to dollar yen and heading back down again towards the support area, which is made up of the mid-March highs and also the mid-April highs between 135 yen and 13 sen and 11 sen. So that's the short-term downside target for dollar yen at the moment. The price of crude oil has dropped dramatically over the last few weeks on recession fears. And if we look at the price of WTI, for example, you can see here that we are once again accelerating to the downside and are now trading below the December 2020 low at just above $70, and are heading down towards the 24th of March low at $66.86, below which we can see another potential downside target, $64.37. Now, why is that the case? Well, basically, we had weaker than expected US jobs data out yesterday. We had also a surprise contraction in Chinese manufacturing activity recently, all of which raised concerns about the economic health of the two largest oil importers in the world, the US and China. And also, according to a Bloomberg News report, the Iranian oil minister Javad Ovji said the country had increased its output by more than 3 million barrels a day, adding to global supply, which is why the price of crude oil is dropping so quickly at the moment and taking out all of its previous support levels that go back to December and up to February of this year. So you can see an acceleration here on this daily chart. As I say, for me, the downside targets are now found to be around $66.85 and below there, $64.37 on this daily financial bet. And for me, that will remain the case, provided we stay below the last reaction low, that is to say, the reaction high, excuse me, that is to say the late April high at $76.86. The great beneficiary of the current uncertainty in financial markets has been gold. As you can see here, the price of gold. And we talked about this yesterday in charting the markets when I told you about the trading range. And when I said that if we were to break out of this triangle and the range basically $2,012 per troy ounce, we would most likely be heading back up again towards the $2,048 per troy ounce high seen in the middle of April. And this is currently the case. So basically here, we now have another buy signal on flight to safety flows out of equities into gold, for example, taking the gold price higher. And we should see further upside if we were to see further weakness in US equities and global equities on the back of this evening's Fed announcement with regards to the interest rates in the US. So basically, from a technical perspective, provided we stay above 1,970, that is the low seen on the 19th of April, further upside is likely to be seen with regards to the price of gold. And silver is quite similar. You can see here we've had a very nice rally of around 28% from the early March lows, take us all the way up to a one-year high of $26.09 in mid-April. And that high was retested on Monday in relatively low volume, though, because it was the May Labor Day, and we then declined again, but held above the $24.50 low we saw last week. And as long as that's the case, the uptrend remains intact. This is just a sideways consolidation phase, and the retest of the $25.91 high seen earlier this week and the $26.09 high seen in mid-April may well be happening. And if we were to rise above those levels, as you can see here on the weekly chart, the next upside target would be the March high at $26.95. So basically, silver also remaining bullish, provided we stay above $24.50. Thank you very much for watching Charting Markets with me, Axel Rudolph. My Twitter handle is at AxelR_IG. Please feel free to follow me on Twitter. Thank you. Goodbye.